Hi, Southern Cross Austereo. My name's Travis Bailey, Senior Financial Planner from Advice First, and thank you for joining us today for the annual Superannuation webinar, which is to provide you with an insight in relation to superannuation, provide you with some tools and some tips, and also some features and benefits of the Southern Cross Austereo AMP Staff Super Fund. What I'm going to do is I'm just going to share my screen and take you to the presentation. Now, today is of a general nature, so here's a disclaimer to say that the workshop that I'm about to take you through contains general advice only, and it's important to consider your particular circumstances before deciding what's right for you. In the email invitation to this webinar, there was also some contact details for you to reach out to contact ourselves at Advice First to receive any information about your personal circumstances or discuss your personal circumstances. And there's also a QR code for you to go ahead and book in a one-on-one with us. So today's agenda, we'll talk to you about who we are at Advice First. We'll get you thinking about retirement, and also, are you on track with a comfortable retirement? How to grow your super, making contributions into your superannuation, especially via salary sacrifice, which I've got a great calculator to take you through. Also the fees and insurances based on the AMP SCA Super Fund, and also some tools and also some tips for how to engage and to learn more about your superannuation. So firstly, who are we? Advice First, we're a privately owned financial planning firm. We've provided advice and education and support to Southern Cross and their employees for over 16 years. We've specialised ourselves in advice and education for more than 41 years. So we're one of the largest privately owned financial planning firms on the coast. We are local, we're Gold Coast based, and we service private, commercial and corporate clients, both nationally and on an international level as well. We have 9 qualified practitioners who specialise in their own individual specific areas of advice. And we're also supported by an incredible administration team. So if you do reach out to us, it's nice to know that depending on what your circumstances are, we're able to align you with an advisor who we think would be most suitable and a best fit for yourself. We provide objective advice. It's non-bias, so we're able to take into account all of your personal circumstances, who your superannuation is with, and then go ahead and obviously make any comparisons for yourself. And the good thing to know with ourselves, we've got a 95% retention rate of private clients, which means that this is just as important for us as it is for you in relation to your pathway throughout your life, in relation to anything financial. So let's get talking about retirement. I guess the main question that we do receive is, how much is enough? How much do we need? And we'll get to that. But how do you want to live in retirement is a huge indicator as to what your retirement would look like. It takes into account really what your lifestyle is going to entail, and obviously what cost that would be as well to go ahead and maintain that lifestyle. Also, how long you will live for. There's a huge demographic shift happening, obviously, in life. It's not uncommon to see someone living beyond, say, their 80s, into their 90s and into their 100s these days. So planning for your retirement to go ahead and ensure that you have enough money there to go ahead and outlive your lifestyle is important to go ahead and plan for those things. Where you live is also important. That can obviously go ahead and orchestrate, how you want to live your life and where you want to live it, depending on where you live and obviously the environment within that, and obviously what lifestyle is contained within that is a huge determinant of exactly how much you need to go ahead and save for retirement as well. So when we look at your retirement goals, we look at, will your superannuation be enough? So you need to ask yourself, are your employer superannuation contributions enough to meet your retirement goals? And also, what are the options there to grow your super? So I'll give you some tips today in relation to how to do that. And then also you need to take into account not only with your employer contributions and also any of your own contributions you're making into super, will that be enough? But also, how will that go ahead and how will that go ahead and piggyback what you may receive from any entitlements you receive from the age pension as well, when obviously you approach Centrelink. And then also, how do you get further advice? So at the end of this presentation, we'll provide our personal details as well for you to reach out to us to ask any of those more personalised questions, and whether it's time for you to sit down to go ahead and look at mapping out your retirement lifestyle. So when we look at retirement, let's look back, say, over 100 plus years. So back in 1909. In 1909, the age pension was for males when they reached age 65. And about half the male population only lived until age 65. So people would normally work up until age 65, and then they would only live maybe for a year or so, and then they obviously would pass away. So the average time spent in retirement was only about 11 years. So there wasn't so much of a need to go ahead and save for your retirement many, many moons ago, because usually the age pension from the government would go ahead and support you. Now, if we fast forward, let's fast forward 105 years ahead. So these are some statistics taken in 2018. So now that the life expectancy of an average male is age 80. And the average time spent in retirement is about 19 years, which just goes to show that these days we work until age, say, 60 or 65, but we're probably going to live until probably our mid-80s as well. So that takes a lot of planning. It takes a lot of accumulation of our money in alternative assets to go ahead and save and to fund for our retirement years of about 20 years. If we look at females are expected to live until around about age 85 on average. So look, you may need more money in retirement, and it may need to last longer as well. So this is where we're here to help. When we look at a comfortable retirement, research performed by the Australian Superannuation Foundation of Australia, association, that it shows that for a comfortable retirement, single people may require a lump sum of around about $545,000. And couples may require a lump sum of about $640,000. And that's for a comfortable retirement, which I'll talk about shortly. And this is also based on an average budget and living standards for those who are at the age of, say, 65. It assumes that to live comfortably, a single person would spend $46,500 per year, while couples would spend around about $65,500 per year. That also assumes that you also own your own home. So how much is enough for a comfortable retirement? Well, for a modest lifestyle, that's just for the bare basics for your lifestyle needs. A single person needs close to nearly $30,000 per year, where a couple, they require around about $42,600 per year. Now, if you step up to, say, a more comfortable lifestyle, like a 5-star lifestyle, a single person would require around about $46,500, like I shared earlier, and for a couple, around about $65,400. Now, to look at obviously what your retirement standards look like, there are calculators available on the AMP website, or even available on the internet. If you Google ASFA retirement standards, it'll actually go ahead and show you what a modest or a comfortable retirement looks like. Now, you can go into these calculators and simulators available, punch in some numbers, and it'll actually help you determine exactly what your lifestyle expenditure would look like in your retirement years. So at the bottom, there is an email address, a website address to go to find out, to take you through to these calculators. So growing your super. The thing about superannuation is it is a guaranteed form of savings. Your employer contributes money into your super, you can then contribute money into your super and your money's invested. But the good thing about superannuation is it's a disciplined way of saving. Compounding interest. When your money's invested, it's invested into a portfolio, and compound interest means that you earn interest on your money that you invest and then on your investment earnings. So that's interest on top of interest, because you can't access your super until you meet your preservation age. For majority of us, that's age 60. So because you can't access your money, you're obviously earning interest in your portfolio, and then you're earning interest on top of interest, which is a compounding effect. It's just a smarter and a more economical and quick way to go ahead and obviously build your retirement nest egg. But when we invest your money, I spoke about investing into your portfolio. And usually these days, when you're first joining an employer super fund, you are placed into a default investment portfolio. So it's a portfolio or an investment that's already established for you. And it's usually established based on your decade of birth and when you were born. But when you invest in these portfolios, you're invested in asset classes such as cash, which are really conservative, or they call them defensive assets. Not a lot of volatility for limited return. So here on this scale, you've got the return there and also the risk that you take to obviously get that element of return. From cash, you can then step up to bonds, or also known as fixed interests. They usually return between 1% and 2% per year. Corporate bonds, they return between 1.5 and 2.5%. So between corporate bonds and cash, or also known as fixed interest, you actually, they're classified as defensive assets. Then you step up the risk ladder, and then you can expose yourself to growth assets. Now, growth assets are assets such as property, or also equities, also known as shares. Now, listed property on average provides you with an average return of around about 8.5 to 9.5%. And then stepping up into shares or equities over, say, a 20-year time frame, they should provide you with around about an 8.5 or 10% return. But obviously, with what comes with these growth assets comes with also volatility as well. So it's nice to have a blend or a mixture of these asset classes within your investment portfolio to go ahead and spread risk and add some diversification for you. Although if you don't want to have a blend, you can actually just go ahead and align yourself to a single asset class or a couple of asset classes if you like. So you can speak to us in relation to what would be perhaps the most suitable investment mix for your retirement portfolio through your super. I talk about an automatic investment that's established for you when you first join your super fund. This is how the AMP life stage or My Super options work for you. If you look at this, this graph here, you've got allocation to growth assets on the left-hand side up to 100%. And then down the bottom, you've got you as a member in your super, your age bracket. So somewhere between their, say their 20s and 35 years of age down the bottom, you can see there in the dark blue of the pie, that's growth assets. So you've got about 95% exposure to growth assets, and you've got about 5% exposure to defensive assets, like I said, was cash and bonds. As you start to transition through your working life, these portfolios automatically de-risk your exposure to growth assets. So when you start to get to, say, 43 years of age, you probably have about 90% exposure to growth assets and 10% defensive assets. As you start to transition through to age 50, you'll find that that's probably around about a 70% exposure to growth assets and say 30% exposure to defensive assets. And then once you get to, say, age 65, this portfolio is automatically de-risked you to, say, a 55% growth assets and 45% defensive assets. So this is an automatic de-risking investment portfolio for you that's in place. Now, this is in place if you decide to do nothing. And this is for people that are in AMP, depending on who your super is with may differ depending on what their default investment portfolios look like. Contributing to superannuation. Now, there are contribution caps. Like I said earlier, your employer makes contributions into super. They're called employer contributions, or also SG, superannuation guaranteed contribution. It's guaranteed by the government that your employer must contribute at least 10% or moving to 10.5% of your gross income into super. So that's classed as a concessional contribution, because that contribution, when it comes in from your employer, hits your super, it's taxed at a concessional rate of 15% tax, and your super fund sends that tax off to the ATO. You can also make concessional contributions yourself. You can make contributions in that you claim a tax deduction for, or also you can salary sacrifice some of your money into super as well. So employer contributions, tax deductible contributions, and salary sacrifice contributions, they're called concessional contributions. And when those contributions go into your super, they can't exceed a contribution cap of $27,500 per year. All right. On the flip side, you can make contributions into super that are from your after-tax dollars. So that's called a non-concessional contribution. You don't get taxed at 15% when you go in, because your money's already been taxed, probably at your marginal tax rate. So when you make a contribution with after-tax money, you've already paid tax at your marginal tax rate, or somewhere along the way, you don't pay tax going in again. So that's called a non-concessional contribution, and your cap for the year is $110,000. So when you're contributing to super, you can make concessional contributions. So that's your employer contributions and salary sacrifice contributions. So when we salary sacrifice, all that is that's directing some of your pre-tax income into super, which could boost your retirement savings as well. Like I said, you reach out to payroll and you say to payroll, I'd like to salary sacrifice $1,000 per year into super. That $1,000 isn't taxed at your marginal tax rate, but it's taxed at a 15% tax rate. So you pay 15% contributions tax when your money goes into super. So up to 85 cents in every dollar is at work for you. So if you put in $1,000, $150 goes to the ATO, and the other $850 goes into your superannuation. The money is invested in the highly tax-effective super environment, and the earnings within your super, you're invested in your portfolio, all your investment earnings are taxed, income tax at, your interest earnings are taxed at a maximum of 15% as well. So here's a calculator or a demonstration in relation to making a salary sacrifice contribution. Firstly, on the left-hand side there, you've got a normal scenario. Let's say an employee here that's on an income of $75,000. The total tax paid in the 2021-2022 financial year is $16,342, which is a tax rate of around about 21.76% tax. So your take-home pay there is around about $58,658. Now, if we move over to the salary sacrifice scenario, same income, $75,000. Let's say this employee takes $70,000 as salary and pays tax on that, which would be around about $14,617, which is a tax rate of around about 13.05%. Now, if you look at superannuation here on the other side, they've decided to salary sacrifice $5,000 out of their salary and put it straight into super. And remember, any money that's salary sacrificed into super is taxed at what tax rate? 15%. So the tax on $5,000 at 15% is $750. So the total tax paid from the salary earnings of $70,000 and the tax on the salary sacrifice is a total of $15,367. Now, what happens here is your take-home pay has reduced down to $55,383, but after tax, your contribution into super is $4,250, which gives you a net benefit of $59,633. Now, obviously, you've taken a little bit of a hit on your take-home pay, but that's been obviously subsidised by obviously your contribution that you've made into super that's locked away, which has compound interest and is invested for that $4,250. But the net benefit there is $59,633 compared to if you took the full $75,000 as income, $58,658. So you can see there's about $1,000 tax saving that you've made by making a salary sacrifice contribution into super for $5,000. So how do you start salary sacrificing? Well, firstly, you calculate how much SG or your employee contributions will add up to for the financial year. Secondly, think about how much you want to contribute from your future salary or your future bonus or your future leave entitlements. We used in that example $5,000. You might decide to start off with a couple of $1,000. And then consider talking to a professional advisor like ourselves for any help deciding how much you should be salary sacrificing and whether it's the right option for you as well. And then once you've decided what the right amount is, then approach your employer and speak to payroll and go ahead and put those salary sacrifice instalments into plan. Now, they can be every single pay cycle, or you can make them intermittently throughout the year as well. Contributing into super after tax. So these are classed as your non-concessional contributions, after tax contributions. So you can contribute additional money into your super, and you might do this if you get an inheritance or a gift that you want to put away until retirement. So you might want to do this to take advantage of the government scheme as well. So you can go ahead and put money into superannuation after tax dollars into super, and then the government will go ahead and help with some government co-contributions as well, which we'll talk about. Now, remembering the contributions, these contributions are after tax contributions, and they're called non-concessional contributions because there's no concessional rate of tax compared to a 15% rate of tax contribution because you haven't received a tax deduction on the money that you've put into super. So there are limits on the amounts of non-concessional contributions you make, and that non-concessional contribution limit is $110,000 per year. You can go ahead and make tax deductible contributions. So you may be able to claim a tax deduction on after-tax super contributions you've made or make before 30 of June of this year. What is a tax deductible super contribution? It's an after-tax super contribution made, such as transferring funds from your bank account into your super fund. So you can go ahead and make an after-tax contribution into your super from your bank account, and then you can later go ahead and put in a tax deduction for that as well, which would then make it a concessional contribution as well. You can also play catch up with your superannuation as well. You can now put more into super at a concessional rate of tax starting from the 2019-2020 financial year. So who's eligible to make catch up contributions into super? It's eligible for those people whose total super balance was less than $500,000 on the 30th of June of the previous financial year. And there's a 5-year carry forward period, which is started on the 1st of July 2018. There's also a work test for people age 67 or over. Okay, so if you are over the age of 67, just reach out to us and we'll let you know whether you're able to make further carry forward contributions. So how do they work? How to play catch up? So back in 2018 and 19, your concessional contribution cap was $25,000. In 2019 and 20, it was the same. 2020 and 21, it was the same. Your concessional cap was $25,000. But from 2021 to 2022, your concessional cap is $27,500. Let's say your employer makes a SG contribution of $10,000 into your super, and you don't make any additional contributions. That means that the unused cap at the very bottom there is $15,000. So for 2018, 19, 19, 20, 19, 20, 20, 20, 21, your unused cap, if your employer put in $10,000, your cap was $25,000, the unused cap was $15,000. You're able to roll that over into the next year. So you're allowed to go ahead and add that onto your concessional cap limit because you didn't use that $15,000 cap. Now, in this financial year of 2021 and 2022, your cap is $27,500. Let's say your employer put in $10,000. That means that there's around about $17,500 that you're able to go ahead and carry forward from the previous financial year into the new financial year for your concessional caps. Once again, reach out to us. We'll be able to help you identify what unused concessional cap you haven't used and what you can bring forward into the next financial year. You can also bring forward your rule of your non-concessional contributions or your after-tax contributions. So if you're under age 67, you're allowed to put in $110,000 per year. Alternatively, you can bring forward up to 3 years of annual caps. So that means you can actually go ahead and put in a after-tax contribution of $330,000, and that's under the bring forward rules. But then you won't be able to make any further additional after-tax contributions until your 3 years has expired. If you're over the age of 67, you are restricted. You can only go ahead and contribute up to $110,000 per year of non-concessional after-tax contributions. Once again, give us a call and we can talk to you about what your non-concessional and concessional contribution caps are. Government co-contributions. So if you earn less than $57,016 per annum, the government may top up your super with $500 each year if you make your own personal after-tax contribution. That's if you make $1,000 of after-tax contributions into super and you're earning under a certain amount, the government may pay up to an additional $500 toward your super to help those income earners top up their super as well. So that's as simple as like a minimal personal contribution after tax via direct debit into your super of $20 per month. You can also have spouse contributions. So if you earn less than $40,000 per year, your spouse may be eligible to receive a tax rebate by contributing into your super. So usually if your spouse makes, say, a $3,000 after-tax contribution into your super, you're earning it's around about $18,000 per year. Your spouse is able to receive up to $540 as a tax offset or a tax rebate off of their tax liability for the year. So a nice little little bit of tax relief for your spouse by making additional contributions into your super as well. Once again, speak to us if you feel that you may be eligible. We talk about market competitive fees. Now, this is obviously specific to the Southern Cross AMP Super Fund. You can see there, depending on your decade of birth, these are classified as your My Super investment portfolios. So someone who's born in the 1960s and you're in the My Super 1960s portfolio, the investment fee is 0.26%. It was originally 0.3%, but it's been reduced. The administration cost for that is 0.29%. There's no member fee, normally $6.50 per month. That's been waived for Southern Cross Austereo employees. There's an indirect cost ratio fee of 0.32% for the 1960s fund. So the total fees and indirect cost is around about 0.87%. So the cost for someone with, say, $50,000 invested in their superannuation would be around about $435. With the recent discounts that have been applied, that was around about $455, so about a $20 per year saving. As we look at those other cohorts, the 1970s, 1980s and 1990s fund, you can see just how those fees vary slightly depending on the decade of birth. But that's based on the AMP My Super portfolios. Looking at when you do join the AMP Southern Cross Austereo Fund, you receive automatic death and total and permanent disability insurance. That's if you join within 120 days of joining the fund. Now, your membership category, look, depending on the insurance, the default level of insurance cover that you receive depends on whether you're a permanent staff or group and senior manager, compared to, say, a casual employee as well. But if you are permanent staff, you're a group or a senior manager, the default level of death cover and total and permanent disability insurance you receive, it's a simple formula. You take 15% times what your salary is, times how many years until age 65. It might be 10 years, 20 years, depending on your age. Times it, multiply those out, and that'll give you your sum insured. And the premiums are paid by you as a member of the AMP fund. If we look at the membership category of casual staff, look, it's an age-based formula. Once again, premiums for your insurance for your death and your total and permanent disability are paid out of your super. Depending on your age, you can see there exactly how much level of cover you receive. You also receive salary continuance insurance as a default member. So once again, you need to join the fund within that specific period of time. For permanent staff, salary continuance, simply if you're sick or injured and unable to work and you're off work for 30 days for permanent staff, you're able to apply for income protection. And this is if you're under the prescribed treatment of a specialist or a doctor. And if you're successful with your claim and you've met out your waiting period of 30 days, you will receive 75% of your gross income, and that's paid into your bank account. It's paid after obviously a 30-day waiting period, and the benefit period is for 2 years. For a group or senior manager, the formula changes slightly. You still receive 75% of your gross income, but it's after a 90-day waiting period, and the benefit can pay you till age 65 or until you return back to work. Once again, premiums are paid by you as a member coming out of that fund. There are some limits in place as to how much automatic insurance you receive. All of these insurances are automatic, and that they are approved up to particular levels. So for your death and TPD, they approve up to $1.5 million worth of cover without any medicals or applications. And for your salary continuance, the automatic acceptance limit is up to $14,500 per month for your monthly benefit entitlement. While we're talking about insurances, it's important to also go ahead and ensure that if anything happens to you in the event of death, that your superannuation lands in the right hands. So that would be meaning that you need to nominate a beneficiary. So whether you're first joining the Southern Cross super plan, or whether you've got your existing superannuation in place, please just ring up your provider and find out who your nominated beneficiary is. Now, when you actually nominate a beneficiary nomination, you can nominate a spouse, which is including your spouse as a de facto. It can be also same-sex marriage or partner. It could be your children. It can be a financial dependent, someone who's financially dependent on you. It could be also a legal representative or your estate. So if you don't have someone who's financially dependent on you, like a spouse or a child, you can leave it then to, say, your will or the person that you've nominated to handle your will. So it'd be worth looking at making sure that you do have a will in place as well. And also independent relationships can be left as a beneficiary. Wanting to learn more, look, you can access all information about your AMP superannuation through the My AMP app, which can be downloaded from your phone or onto a tablet as well. And that provides you with all of your account information that's accessible to you. You can even check on there as to who your beneficiary nomination is, and also to ensure that it's actually kept up to date. If your circumstances do change in relation to your relationship status, make sure that you update your beneficiary as that evolves as well. With AMP, there's also Financial Wellness Hub available for you. There's financial wellness programs. There's face-to-face support, phone-based, call us as well. We're here to go ahead and filter any questions or queries that you may have. And also AMP, they have a subscription where you can listen on Spotify, Apple Podcasts and Google Podcasts as well. And also there's complimentary phone-based advice provided through Advice First as well. You can tune into AMP Help Series webinars as well, which is more about understanding your super, market and economic updates, estate planning, getting ready for retirement, redundancies, keeping on track with super, or even women in super as well. There's regular updates in relation to these webinars. Also with Advice First on our social media platforms, whether that be Facebook, LinkedIn, or Instagram, you can access articles of important information. So a couple of times a week, when you actually friend us on these social network platforms, you'll have information that comes through educating you in relation to topics like wealth creation, wealth protection, retirement planning, estate planning, borrowing money as well. So look, being independent, privately owned financial planning firm, we get to also educate you in relation to information, anything financial outside of the scope of superannuation as well. But finally, look, here are our contact details. There's a QR code that if you'd like to book a one-on-one with us, feel free to. We can organise a phone one-on-one or like a webinar one-on-one as well. But we've got Kim there. She supports the superannuation administration team. She will be able to go ahead and take any queries, filter any queries, and navigate you into the right hands. There's myself as well. There's also Lisa as well. Lisa Forbes is a partner and a home loan specialist, a complimentary service for yourselves at Southern Cross, that if you're looking for a home or in the market or wanting to make a comparison against your existing relationship that you have with your bank, Lisa is a broker. She can broker the market and provide any advice there as well. And then there's also AMP for you to reach out to if you'd like to go direct with them. But that concludes today's webinar. Thank you for your attendance. Once again, if you'd like to book in a one-on-one, please hit the QR code there as well, and we'll be happy to take your query. We're here for anything financial. Once again, thank you for your time and all the best. Cheers.